Hi. It seems the small cap fund category has become investors' favorite mutual fund category over the last 1 year. In fact, Amphi data shows that a massive one-third of the mutual fund industry's equity net flows of more than 30,000 crores have flocked into small cap funds over the last 1 year. But in spite of this stellar rally, is it advisable that we put major allocations towards this high-risk category? Or is there a risk of correction? Let's learn more about what's happening in the small cap segment. Is it looking frothy or the valuations are reasonable? We will hear from the expert today, Sahil Kapoor, Head Products and Market Strategist, DSP Asset Managers, in this episode of One Step Ahead show by DSP Mutual Fund. Welcome to the show, Sahil.
Thank you, Shimona. Thanks a lot.
So before we start the conversation, request all our viewers to share their questions in the comments section and we shall get back to you at the earliest. So Sahil, let's begin by breaking down what exactly are small cap stocks and what makes them so popular among the investors in the market.
Sure. So when you go by the regulatory definition, any company which is beyond the first top 250 companies in terms of the market cap. So from 251, number 251 to 500, that universe is called small cap, and even companies beyond 500 are called small cap. But recently, a lot of people have also started calling, companies smaller than 500 company as micro caps, right? So small cap by definition are companies beyond the top 250 companies. And the idea with small caps is that they have lower market capitalization than bigger companies like mid and large caps. And there is a belief that smaller companies, if they're able to grow, they can create multi-bagger outcomes. That means they can deliver very high returns. A lot of people believe that they can, pick gems from the mines, and these are the small caps, small businesses which will grow over time and create great outcomes for investor. That is a belief when people look at smaller companies. So they are attractive, and secondly, also because many a times what we see is that they have smaller market cap, and in many instances, although it is not mathematically correct to say, many of these companies are also lower priced. So their share prices are not very high in absolute terms, although it does not tell you anything about the valuation of a company or how expensive or cheap it is. But these are the things which attract people, attract investors, and they've been, the crosshairs of investors for a very long period of time. Yeah.
Great. So, Sahil, what's your insight into the current market conditions for small cap stocks? In fact, we would love to have your view. Where do you think small cap is moving, and where do you see this in the next 2 to 3 years?
Sure. So, Shumana, if you look at history, small caps have actually outperformed large caps in India over a very long period of time. If you look at last 25-year history, the index, if you look at the, let's say, Nifty small cap 250 index, it has delivered slightly higher returns than, let's say, Nifty 50, which is large cap, or even the Nifty 150 mid cap index. And that also brings a lot of attention from investors because the long-term returns are very attractive, right? But small caps also historically have been more volatile. That means if, let's say, a Nifty, which is a large cap index, in any particular year, if it moves up or down by 10%, smaller caps could move up or down by more than 15%. So they're inherently more volatile versus the Nifty. And also, another important point to note is that they also have very long lull periods. So, for example, between 2008 peak, 2007 or 8 peak for small cap index, and if you fast forward to the COVID bottom, for nearly 12, 13 years, and an unlucky investor would have made no returns in small caps, right? But there are also periods where small caps perform very, very well. They rally at a very fast pace. A case in point is last 6 months, small cap index has risen almost 50%, right? And if you look at even more micro cap index, it has gone up by 71%. So these stocks and this capitalization usually sees two kind of activity. One, long stretches of no performance. Second, when the performance comes, it comes in bunches and it is very, very large, right? So it makes a lot more sense to look at this purely from a long-term point of view than from a short-term point of view. To coming to your question on, what is the outlook on small caps? So one clear thing is that, as I said, last 6 months, we've seen a stellar rally. At the end of 22, we had clearly highlighted that small cap stocks appeared more attractive based on valuations. So if you go back to last 15 years, go back to, let's say, 2007-8 peak, since then small cap underperformed, not only in India, globally also. But then COVID happened, these stocks crashed, badly, and then they recovered. All capitalization recovered, large, mid, and small. But in around September 21, these stocks, peaked out. And for about 2 years, they did not perform. So they went into sort of a consolidation, right? And the earnings caught up, stocks became cheaper. So in about November, December 22, we said that this is a good place to be. Small caps appear below average valuations. They were trading below 18 times, 17 times price to earnings multiple. But in the last 6 to 8 months, there has been a very strong rally. As things stand today, small caps are no more attractive. I think they are priced at a higher P multiple than their own history. You can say that their valuations are right now expensive. Second, they're also overheated. A lot of these stocks have rallied so much that in a very short span of time, not only on valuations, but also on other parameters, they have become overtly overheated. So at this point in time, I would say that investors should exercise caution in this category. This is not the time to be more aggressive in this space. You have to be very, very vigilant on what type of companies you buy. You have to be extremely bottoms up in terms of the quality of stocks that you buy, and extremely careful in your holding period.
Right. So Sahil, two important things that you mentioned about small cap segment as a whole is its high volatility and a long lull period. And given that there's so much of rally also happening in the current, in the current scenario. So when it comes to the average investor, how should, what kind of expectation they should have from this segment? And what do you think are some of the key factors they should look at when they consider investing into small cap mutual funds? And of course, if you can also share some of your learnings as an investor, as you have started.
Sure. So Shumana, first thing is that when people look at small caps, the best way to go about them is to do a SIP, systematic investment plan. What it does is that it nullifies your timing element, which sometimes becomes crucial in small caps, right? So because you are buying through the whole series, your outcomes are time agnostic. You don't have to time the market at all. Second, also, you don't commit a large amount of capital upfront, right? Because you're going to accumulate units over time. So it helps you average out in terms of valuations, and you get close to average market valuations over a 10-year period or so. So I think the first thing is, when investors look at small caps, the go-to strategy should be SIP and not lump sum, unless and until you are in a very bad market where markets have crashed and valuations have become extremely cheaper versus their own history. At that point, you could look at lump sum. But SIP, I think, is the first instrument. And secondly, what we've seen is that when markets are at all-time high, so as we speak today, small cap index is less than 1% away from lifetime high. And historical data has showed that if you do a SIP when small caps are at lifetime high, your outcomes are much better than doing a lump sum or doing any other SIP strategy rather than a plain vanilla SIP, right? So because if you, let's say, start today, if you're a new investor today and you start doing a SIP today, and let's assume the market falls, right? And the market corrects, marginally, you will end up buying very few stocks at the peak. And as the market falls, you will keep on accumulating more units. So I think right now, if you want to invest in small caps, the best plan is to do a SIP and not do lump sum. And secondly, don't be too aggressive in terms of overall allocation. Be more mindful and slightly more conservative in approach. Second thing is you asked what to watch. So see, small caps, a lot of people uh, assume or interpret that if they buy smaller companies, they will become big companies in the future and they will make a lot of money. So let me share some data. We looked at about 700 small cap companies. Out of those 700 small cap companies, only 7 companies became large caps, right? So the failure rate is very, very high. So, for example, I can tell you that over a decade, almost two-thirds to three-fourths, 66 to 75% of all small cap companies don't deliver any returns, right? So it's a very, very niche field of investing. And at the same time, what we've seen is that active investing or active managers, small cap funds which are active in nature, have been able to outperform indices. So there is a big dichotomy in the data that I told you. So the idea is that in small cap, you have to be extremely quality conscious. You have to pick companies which have good balance sheets, good managements, and they are able to, survive over long cycles. Second and more important point, they should be able to grow their earnings over time, right? So, for example, the small cap index over the last 10 years has delivered only 10% earnings growth, the overall index, right? It's not very high. But if you look at some companies, earnings growth has been as high as 25% CAGR. So, if you are in good companies in small cap, they can deliver good, handsome returns to you. So, A, quality of the business, B, quality of the balance sheet, C, what kind of earnings growth is happening in this category, and of course, the valuation. I think that is one of the most important pillar. These are the things that you should watch out for when you are looking at small caps, and also, active investing and or quality filter or filtering the stocks for quality would be a game changer for investors in this category.
Great. So what I could understand and what the major takeaways for the average investor is to understand that SIPs could be a very important tool in the current market segment. We should not be too aggressive, and to apply quality filters when we are choosing such funds. Sahil, you also spoke about small cap businesses, and we would want to know what are the factors that impact these small cap businesses, and are there specific economic or market conditions that can impact the small cap stocks more than what they do to the other segments?
Sure. So, Shomana, see, one statement I usually use is that profits are market cap agnostic. That means if you are a small company or a large company, if you are a good business, you will make profits, which is what is required from a company to perform, for its share to perform, right? So these nomenclatures of mid, small, and large have been created for us to understand the complexion of the market, right? So small caps are also subject to similar, let's say, market environment or forces of businesses as other companies, but there is a fundamental difference between, let's say, a bigger company and a smaller company, which has become more apparent in recent times. So one difference is that smaller companies are not able to spend a lot of money on technology in upgrading their business at a fast clip, which many large companies are able to do. And that is one of the reasons why we have seen that with this new, tech world surfacing over the last 15 to 16 years, a lot of larger companies have outperformed. They have accumulated more profits versus the smaller companies garnered more market share because they've been able to upgrade their businesses at a faster clip. So this is one, let's say, drag for smaller companies, that companies which are in a very competitive industry, and if there are larger players in that industry, they find it tough to gain market share. Second and more important point is that many smaller companies, if their quality of balance sheet is not good, they might have to pay higher cost of capital. So because of which their profitability could be lower. So they become more, let's say, impacted if interest rates rise or financial conditions become more challenging. So small caps get hit harder. Third point, if there is an overall economic malaise or economic slowdown, smaller companies find it tougher to maintain their sales or revenue. We've seen this during COVID times. We've seen this in earlier crises also. So these companies are subject to more variations in their profitability. And that is also the reason why their stock prices are more volatile, right? It comes from the business itself. So these are the 3-4 factors. And of course, these factors, because they impact small cap, this is also that, fund managers and investors, they keep tracking these important inputs for these businesses. And the other more bottoms up reason for these companies to do well over time is to keep gaining market share in where they work. And that is how they become bigger in their own pie and they grow into, let's say, larger companies. But one point I'll make again, most small cap companies which have beaten large caps in terms of returns, many of them did not become large cap companies or even mid cap companies. So smaller companies remained small and yet delivered returns. So many investors believe that small cap company, if I buy it, it will become a large cap and that is why I will make returns. That may or may not be true. Many small cap companies, while remaining small, they can still deliver very good returns over time because they are profitable and they continue to have good margins over a full cycle. So I think these are the few factors to watch out for.
Great, Sahil. Another very common question that I generally get from our participants of different sessions that we conduct from DSP Mutual Fund is, do small cap funds also enable the fund managers to invest in innovative startups? What's your take on that? If you can tell us a little bit on that.
So recently, Shumana, what we've seen is many companies which are like startups and they come into the market, they don't readily get listed, right? They try to go to the PE firms and raise capital privately, and unless they become sizable mid or large cap, they don't come to the stock markets, don't give a IPO, right? So the answer to your question is both yes and no, right? There are few companies which needs access to public markets. They will come and do an IPO and raise funds, and thereby investors can benefit from them. But I think it's a mixed bag, right? So there have been a few cases where smaller companies have gotten listed over time, and then they have grown and shown a good promise of growth. But I think you can't really invest in small cap for only this reason. It's a reason which can happen on its own. And second thing is that I prefer to have a very large operating history of a business if it is a small business. So for example, if there is a new company which has only 1 or 2 years of vintage and it gets listed, I will wait and watch to see how the business cycle plays out over the next 5 years rather than jumping and investing in such a company, right? So I'm better off, even if there is a small company, it has a 5-10 year old history, which I can see the operating history of the business and the ability of the management to go through all the cycles. That I think is a better bet rather than jumping on a new age business, which is a small cap and there is an IPO, and that is why I buy that stock because it's a small company. That may not be the most appropriate frame of reference to look at it.
Absolutely, Sahil. I think you mentioned a wonderful point that one surely needs to check a few business cycles before entering into or investing into one particular company, especially a small cap company. So we have more questions lined up for Sahil, but before we move on to the next set of questions, to all the audience here, if you enjoy our content, please like the video, subscribe to our channel, and press the bell icon to get the latest video updates from DSP Mutual Fund. So Sahil, another interesting question that I have come across is about earnings and valuations. Market analysts suggest that the valuations of small cap and mid cap stocks are running quite high. In fact, you also did mention. Firstly, what does this mean? And secondly, what's the reason for these high valuations and with having so much of high earnings? And is there an upside that the small cap segment is limited now for? How would an average investor, interpret all of these information?
Sure. So, Shomana, let's take an example of a small cap index, Nifty Small Cap 250. Over a long period of time, last, let's say 10-15 years, when you look at the past history, its price to earnings ratio on an average is between 19 to 20 times, right? Currently, that ratio has gone upwards of 26, 27 times. So the index is trading in the top 20 percentile of its own valuation history, which means that it is expensive zone, right? So if you draw a zones of where it trades, right now it is an expensive zone. Historically, what we've seen is that when it reaches this kind of a zone, the forward 1 year, 3 year returns, they fall, right? They tend to correct or consolidate for a longer period of time. So even if you are an investor, or you want to invest today, starting afresh, you should be ready with very low returns, maybe in single digits. Second is, what is the reason for small caps becoming too expensive? Largely, I think last 2 years, as I said, there was a long consolidation period. And secondly, then, demand started picking up in the overall economy. Many smaller companies started to show earnings growth. They were already very cheap, right? And large caps were not doing well at that point in time. Largely, they were consolidating. And small cap companies, by the virtue of the incremental growth that they showed, they started attracting a lot of investor interest. And what we've seen is that there is no reason or rhyme that we can put on why market does what it does, right? Markets can do anything at various points in time. At this point in time, most investors like them. They are bidding up the prices uh, in expectation that earnings will fall, right? So currently, we believe that it's slightly overdone, and we are better off investing in these companies when they are close to their average valuations or so, which is some time away, right? So earnings will keep on rising. Maybe the PE ratio will keep on declining, and then we'll get an opportunity where again these companies or the index overall will start appearing more logical. Till that time, I think the best strategy, as I said in the beginning, is to do a sip.
Understood. And what's your view on the current geopolitical tensions that's happening around? And should investors be wary about that in this rally as well?
Sure. So, Shomana, we've done a brief video, the Netra call that we did. I will encourage people to go and watch it for more details. But very briefly, I think it's a geopolitical scenario which you can't shove under the rug. I think it can have more repercussions for global economy and particularly in the Middle East. That bracket is very, very sensitive for crude oil prices. The analysis that we've done shows that if this continues for 1 or 2 months, crude oil prices could go up significantly. So we had Russia-Ukraine war in 22. Prices reached 120, $130 for crude oil, and then they declined. If the current crisis that we are seeing, if it escalates, I have no way of saying whether it will or not, but just assuming and building a scenario, if it escalates and goes higher, crude oil prices could go much higher beyond what we saw during Russia-Ukraine crisis. And that could be a big spanner in the works for markets across the world, not only in India, but across the world. India, of course, being very sensitive to crude oil prices at such high prices, can also get hit. So I would say that be more conservative and be a lot more attentive to what's happening. And if there are signs from the oil price, take it into your analysis and make a great understanding of what kind of risk are you holding in your portfolio. So the idea is to be slightly cautious with all this happening geopolitically.
Right. So, do you think under this scenarios, the existing small cap investors, should they consider realigning their portfolio and shift it towards large cap? What would you suggest?
So, Shomana, shifting or selling out or booking profits, although we can discuss it, it's much more harder than in real life. Why? Because you end up paying taxes, right? So if you are holding a stock portfolio, if you exit it, you pay either short-term or long-term capital gains tax. Even if you re-enter, let's say even if you save 10% in correction, you would have still not made any difference because you had to pay 10 or 15% tax, right? Or even higher, depending on your tax bracket. So I think it's a very, very individual driven question whether to book profits and shift or not. What I understand is that all your incremental investments could be more conservative. You could look at only doing SIP, or you could look at doing any other, let's say, a multi-asset strategy, going and buying some gold. So that is how conservatism can be exercised. people who have the ability or the appetite, to redeem and pay taxes and still re-enter, time the market carefully, they can, think about trimming, let's say, their excess positions if they have excess positions in small caps and shifting somewhere else. But I think it's a very personal call and better done with your financial advisor than, over my advice.
Absolutely, that's quite fair. Coming back to what's happening in the industry and in the small cap fund segment, industry reports show that many small cap fund managers, they are deploying into new opportunities when it comes to small cap and micro cap space, instead of holding cash. Do you think it's safe in the current scenario, given that poor liquidity could be a concern?
So I think as a starting point, if you think about it from a first principles of investing, if a manager is getting more funds to invest, he should continue to invest in good quality companies, right? So the dilution of investment philosophy should not happen for the reason that you are getting more funds, right? So I think the answer to your question lies in that. If a fund manager is following his investment philosophy, if he believes that he's getting funds and he's able to deploy in businesses which are, according to his analysis, better, then he should continue to do that. But going away from your investment philosophy because more funds are coming in, that could be detrimental, right? So new or old does not matter. What matters is whether they fit your investment philosophy, which I think should be built on quality, valuations, and longevity of the business. If those criteria are getting met, then I think there is no harm.
Right. So, Sahil, market is full of many small cap funds. What differentiates DSP small cap fund, and why do you believe investors should consider it?
So, Shumana, first thing is that DSP small cap fund overall has a very low churn ratio, right? So, not many businesses are sold. Most businesses are bought from a very long-term perspective to play through the cycle. Second and more important point, it is very, very quality oriented. The fund manager exercises extreme caution in picking good businesses which can withstand crisis, which can withstand bad phases, and they still survive and continue to do well over time. And third thing is, overall, the quality bucket within the small cap flavor is also married with valuations, right? So it is made sure that valuations are at appropriate levels and you are not entering businesses which are trading at extremely high valuations because there your returns could get compromised. So I think this is the framework which sets it apart. As I said, one of the lowest churn portfolios across the industry, and it is also fairly concentrated versus many other funds which are large, but they continue to hold many stocks, much more than or maybe as high as the index number, right? So this is a particularly better suited portfolio for playing through the cycle. And for small caps, the cycles are usually 5 years, 7 years, and 10 years.
Right. So, Sahil, we have also seen few small cap funds with larger asset sizes. They have stopped accepting lump sum subscriptions. However, the category still has SIP subscriptions flowing in. Where will this money be deployed in this high valuation phase? And if you can also tell us a little bit about the plan of action for DSP Small Cap Fund.
So we have remained open and we have encouraged all our investors to continue to do SIP, not only today, but otherwise also. We believe that doing SIP in small cap is much more logical. Second thing is, there are a lot of opportunities even in the small cap space where the quality is maintained. And if those opportunities continue, we will be open for subscriptions, right? So as I said, investment philosophy will not change depending on where we are. And as I said through the video, that it is time to be more conservative in nature. We continue to believe that you should, as investors, choose SIP over any other mode of investment at this time.
Great. So, Sahil, you did share a lot of insights about small cap funds. I'm really intrigued, I'm really curious to know, do you yourself invest in small cap funds also? And typically, what percentage of your portfolio do you invest in into this particular segment?
So Shomana, as of today, I'm completely invested in large caps and mid caps. I don't have any other, investment flavor to small cap other than one of my funds holding some small cap companies, right? So if you dissect all the holdings, my exposure to small caps will be around 5 to 6%, which is not very large. Second thing is why. Largely, I'm a very conservative investor. I believe in investing for at least 10 years or more. And I think there is a good potential for larger companies and mid-cap companies to not be more volatile, right? And that is the reason that I believe and I continue to invest in slightly larger companies. But I also invest in smaller companies when the time is right. If I get a COVID-like crash or a great opportunity to invest in, I will certainly increase my exposure to these spaces. But on ongoing long-term basis, I think my portfolio concentration is slightly lower to small caps at about 5 to 6%.
So, Sahil, thanks so much for joining us today and sharing your insights and analysis on the small cap as a segment. I'm sure our viewers have much more clarity on how much they should consider investing in this segment, and of course, for the right reasons, as you have stated. To all the viewers here, if you need help managing your money, click the link in the YouTube stream and we will contact you ASAP. And yes, don't forget to leave your feedback about this conversation. Thank you for joining.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.